A very good afternoon, good morning. Welcome to HYCM's live trading workshop with myself, Giles Coughlin, a chief currency analyst. Very nice to see you all here. Hi, Rick. Good to see you. Mohammed, Kirash, Zafaharale. If this is your first time here and you're just signing in, very warm welcome. And we will be looking at the key narratives driving markets at the moment. I'll be helping us make sense of what's going on so we can plot a clear pathway through. These are tricky markets and there's no shadow of doubt with that. So we will just be working our way through it. Let's see how we're doing for numbers. Okay, just as folks are coming in, don't forget as we look at this whole trading webinar, the whole idea of this trading webinar is you look over someone with a professional trading background. I work as a professional trading analyst. I've worked for a professional fund and now trading my own finances, and I'm just going to run through with you the key aspects, things I'm looking at. And the idea is that not that this is a signal service, that it's an educational service. And we'll be looking at the NFP print on Friday. That's going to be quite crucial, and I'm just going to be zoning us into this US growth story so we understand exactly what's going on. So we need to get some context for the NFP print on Friday, and the best way for us to do that is just start reminding ourselves of what's going on in terms of overall economic themes. Now, hi Kirash, yeah, very warm welcome. Well done, you found the question panel. At any point during the webinar, Kirash, if you want to ask a question, I will either answer it as I'm going through the webinar, or I will pick up all questions at the end. So I always answer all questions as long as time's permitting, and there's plenty of time today, and any question you have. And also a warm welcome is that, don't feel, you're going to ask a stupid question. I believe there's no stupid questions apart from the question that isn't asked, because how can you know unless someone tells you? And that's the economic world is full of like little unknowns, and over the years I've answered many questions, so very happy to help. Right, without further ado, let's get into the webinar. Now, if you just take a look at this chart, what you'll see is three lines: the blue, the pink, and the orange. Now, the blue line is inflation, the pink line is your 2-year bond yield, and the orange line is your 10-year bond yield. And the grey bars on this chart are US recessions. So what you'll notice is just before we have a US recession, we see yields surging, inflation surging, and then they fall out of a recession. Into a recession, we have yield surging, bond surging, inflation surging, and then they fall out of a recession. Into the recession, yields rising, inflation rising, and then out of a recession, inflation and yields fall. Now, the ways that central banks can address high inflation, you see here this blue line, inflation's surging, and it's been hit by a double whammy. First of all, we had the Russian-Ukraine crisis, which hit supply issues, and we saw a surge in commodities, oil, copper, iron ore, absolutely ripping higher. Now, we're seeing another surge in inflation, but this is on the Russian-Ukraine crisis. So first of all, it was COVID-19 supply chain bottlenecks, and now it's the Russia-Ukraine crisis. So inflation is surging. It's 8% now in the US, and bond yields are surging as well. There's been a rout in the bond market. Now, if we just take a look here, now a lot of the charts that I'll be looking at today are courtesy of Financial Source, for whom I also work as a currency analyst, helping them and their subscribers plot their way through. It is possible for Financial Source access for some of our clients, so do get in contact with your account manager if you would like that access. If you just take a look here at the bond market, and what you can see, do you see how yields across the world have been surging higher? Now, when yields move up, that's the bond actually being sold. So this surge higher in yields, which is what we've been seeing here, the 2 and the 10s, and here we have the 2 and the 10s in the US, I'll just get rid of the spread, and you can see the 2s and the 10s surging higher. This means that there's growing concerns that the US is heading to a recession. And the catalyst that traders are looking for is slowing growth metrics. Now, one yield curve that you'll see referred to a lot is called the 10 and 2 bond yield spread. And you might have heard of the inverting of the yield curve. Now, all that is very, very simple, yeah, is that when the yield curve drops lower, if it goes negative, and you can see here it's just positive 0.051%, if this moves negative, that's an inversion of the yield curve, okay? Now, an inverted yield curve typically signals a recession. And each time the yield curve has inverted over the years, it's signaled a recession every single time since the 1950s, apart from one occasion. So if the yield curve does invert on the 10s and the 2s, that's not to say that there will be a recession. It just means the probability of there being a recession has really grown. And all the 10 and 2 is the 2-year bond yield subtracted from the 10-year bond yield. Now, just so you understand the yield curve, the short end of the yield curve, like your 1-year, 2-year, are very sensitive to interest rate expectations. And the Federal Reserve is now expected to hike interest rates 9 times. The longer end of the yield curve, the 10s, 20s, 30s, are more sensitive to growth and inflation outlooks. So what this means is that the shorter end of the yield curve is rising more quickly than the middle, longer end of the yield curve. And that means that traders are expecting high interest rates, but slowing growth. That's why this inversion of the yield curve typically signals a recession. So you now can see that key driver. And that's why traders are asking themselves, are we heading into a US recession? Now, in order to answer that question, what we're going to be looking at is, let me just pull up. We're going to be looking at US growth metrics. Now, if you look at some of these data points that we've had from the US, we can see that the Fed's quite happy that US economic growth is good, and it is good, but there's starting to be a few worrying signs. And some of those worrying signs are things like the University of Michigan sentiment. That's a sentiment indicator, and that picks up domestic households and how they're feeling about the state of the economy. Now, some analysts consider that the most accurate indicator for a coming recession. The rationale and the logic behind that is that domestic households are far more sensitive to rate price increases and to slowing economic growth. And when households start to feel negative and start to cut back on projected spending, that's a good indication that the economy as a whole is slowing down. That makes sense as well, because 70% of the US GDP, and it is the largest GDP contributor in the world, 70% of that comes from wages. So if households are feeling a little bit depressed, it means they're expecting lower wages, and it can be an early indicator. Now, at the moment, the data's okay. It's pretty strong, but we've seen consumer confidence down, University of Michigan sentiment down, the latest mortgage rates have dropped in terms of the people taking mortgages, and interest rates have increased. So now if you think about it, if you're a consumer in the US, you're facing the prospect of the Fed hiking interest rates 9 times this year. That means higher interest rate payments on your credit card. Have you got a short-term loan? Highest interest rate payments. Have you got to renew your mortgage? Higher mortgage rate payments. Oh, there's also the supply chain crunch that's impacting fuel prices. So all of a sudden, I'm paying more for fuel, more for my mortgage, more for my car payments, more for my credit card payments, more. You see the picture. And that's why growth can, when it slows, can slow down very, very quickly. So investors are eyeing the incoming data from the US now extremely carefully, and non-farm payrolls is going to fit into that picture for us, okay? Now, non-farm payrolls is usually a late cycle indicator. So usually it's one of the last things to move. So not necessarily expected to move, but we have got PCE data out tomorrow, and we've just had the non-farm, the ADP data has just come out as well. Now, ADP data is coming out pretty much on target. Now, ADP data is not a very good predictor about what's happening for the non-farm payroll. You can see here ADP data, it comes in, it's not that strong a predictor. It doesn't necessarily correlate, but the ADP data does get factored into the calculations for the non-farm payroll expectations. So a good ADP print does bump up expectations of a good NFP print on Friday. So we've just taking a look here, we have had the latest ADP data in, and you know, it's not bad. We can see ADP comes in 455k, ADP national employment 455k versus 450k, and that's, you know, pretty solid. We also have had core PCE data coming in as expected, and GDP coming in a little bit of a miss, right? Now, what with the PCE data, the Q4 is less important. The data out on Thursday is going to be more important because that's like for February. So if we start to see slowing US economic growth, that is going to weigh on stocks. So at the moment, this now you understand the picture. So what are stocks going to do? Are they going to rise or are they going to fall? Now we had that sort of rally off the lows from the bottom of the Russian-Ukraine dip. Now, if you go along to my blog, and I'll just give you the details here, playbook. All right, I posted this very interesting article called The Geopolitical Playbook, What's the Trade? And if you're new to trading, right, I'm just going to send you the hang on a minute, struggling together. There we go. Right, hang on. I'm just going to send you the link in there. I'm going to send you the link in the chat box. Oh, for some reason I can't. Just bear with me a moment. Just try and send you this link. I'll give it 2 more tries, and then if I can't, okay, for some reason I can't type here. No, not to worry. Okay, here's my link, HYCM Lab, and I put some good articles up there. And one of the articles I put up was that stocks usually take geopolitical events in their stride. So you look at all these events, you know, the 6-day war, the Yom Kippur War, US terrorist attacks, Saudi Aramco drone strike, even Pearl Harbor attack, which brought the US into the Second World War. The reaction in stocks is much milder than you would expect. Given the huge human cost, the actual financial cost is quite low. So you can see on average, the S&P 500 only has a 6.1% drawdown, and it tends to bottom in about 22 days and recovers in 50 days. So if you take, like, you know, the start of the Russian-Ukraine crisis, and, you know, yeah, stocks have fallen, but you see they've already made up, they've just recovered the dip now. So that dip, which I was explaining, you know, the trade is to buy the dip. Historically speaking, it is to buy the geopolitical dip. So that's what you need to, you know, look out for. And now you see that stocks have rebounded above the losses from the invasion of Ukraine, because the S&P 500 Stock 600, Asia Pacific Index, all indices have erased losses apart from emerging markets. You can see the S&P 500, the blue dot, look, it only fell 2.5%. And it bottomed out very, very quickly. So, learning point for yourself, if you don't already know this, the geopolitical playbook, the trade is buy the dip, okay? That's the general rule of thumb. Now, that dip has now been filled, okay? So this is not a dip to buy. That time has been and gone. So now we're into that question of what's going to happen next. Is US economic growth going to slow? If US economic growth is going to start slowing, then that means the US is entering a recession, most likely, depending on the extent of how fast it slows, and then we'll see stocks fall. Now, stocks can gain alongside rising interest rates as long as growth is sufficient to keep up. Now, at the moment, the US economic growth is okay, but signs of slowing, and we'll start to see stocks falling. So that's why I'm neutral on these major indices, waiting for more data. And the NFP is going to help form part of that picture, but that picture is going to continue to develop. There's one exception, and that is China's 50 index. Now, I am long China's 50 index. I've got a substantial position in, and I'll explain the rationale. Now, the relationship here is very different. Do you see how it's fallen 40% since last year? That's a large percentage, okay? Now, the potential is for a very large gain here, and we've got a weekly bullish pin bar, strong rejection area. This would be a very key area to go long. We had some upside overnight. Now that was on the People's Bank of China injected liquidity into the Chinese banking financial system, so making it easier for banks to lend, to loan money, and that increases liquidity and helps financial conditions in China. So the reason I'm bullish is that unlike the rest of the world, which is looking at cutting interest rate, looking at rising interest rates, the People's Bank of China is actually looking at cutting interest rates. And they've stated they want to support stability. So long China 50 with stops underneath 1200 make a lot of sense, looking for a first test up to 14,500 and then potentially moving up to 16, 18, 19,000 as over the next sort of 12, 18 months. Just watch what instrument and how you trade it, because you want to get a instrument that you can ideally hold for a long time, but that looks very good value at the moment. And China's 50 index has got different drivers than the other major world indices. You can see the yen has been extremely weak. We know why that's been so weak, because Japanese financial year end, oil prices, when oil prices rise, as you can see here, rising oil, that weakens the yen. Falling oil strengthens the yen. Rising oil prices weakens the yen. There's a strong correlation between oil prices and the yen. There's also a strong correlation between 10-year yields and the yen. Rising 10-year yields, falling yen. Rising 10-year yields, falling yen. Rising 10-year yields, falling yen. So with yields surging higher, oil prices surging higher, Japanese financial year end, the move in the yen has been absolutely relentless. But that's now coming to an end, because Japan's financial year end is here. We also have had Bank of Japan speakers talking about some concerns regarding the weakness in the Japanese yen for the last 3 days. So, if you're looking at a potential short, it would be like shorting at market, maybe stocks above 122, looking for maybe a move back lower down to 119, 116. It's not a trade I'm in, but a number of people have been asking me about it. And I think if I was going to short the dollar yen, it would be something like this. The trade that I was looking at yesterday was the pound yen. I'll just show you here. Was the pound yen short, and that was on the very simple trend line break. Okay, you can see it had a nice trend line break, and price has just been tracking lower on that. Now, in terms of opportunities, they're very tricky at the moment. So medium-term outlook, we'd expect medium-term upside in the euro pound, and that will be because the ECB are expected to be more hawkish than the Bank of England. Both central banks are taking a slight shift. The ECB is turning slightly more hawkish to contain surging inflation. The Bank of England is turning slightly more bearish so that they don't hike too aggressively and pressurize the UK consumer. So that's why the euro pound's been tracking higher. That's something that we've been looking at. So with all this being said, what we need to look for now is the following data as we approach the, and we're looking at a couple of opportunities here. So let's just look at this week. All right. So what we're looking for here is, first of all, Thursday, the PCE data for US personal consumption. If we see a drop in this personal consumption data, then that sets up the emphasis for a lot of focus on the NFP data on Friday. Now, expectations are for it to come at 4.85 and unemployment is 3.7%. If the non-farm employment comes in below kind of 300,000 and unemployment rate is above like 3.9%, then expectations will start to grow that perhaps the US economy is slowing down. That would result in 10-year yields moving lower. So we expect US 10-year yields to drop lower. Yeah. And then we'd expect the dollar to drop lower. Let's just find the dollar chart. Yeah. We'd expect the dollar to drop lower, and we'd expect that to boost gold higher. So the opportunity that I can see potentially is if we get a non-farm payroll miss, the opportunity is on a miss. If it's a hit, that's only what's expected, but a miss will be a little bit of a surprise. And I would see potential gold upside. Now, you can see here, this is a Harami inside bar, false break of a Harami inside bar. That's a powerful bullish pattern. If this market closes like this, or more bullish than this, that's indicative of higher prices next week. So a big miss on Friday sets up the opportunity for potential gains in gold over the next couple of weeks. So that's what I'm looking at, but I would need to see a non-farm payroll miss. That's a real key thing. And just so you know that relationship, this chart is what you need to look at. Do you see, you've got gold here in gold, you've got the dollar index in red, and you've got real yields in blue. Now, real yields is just 10-year bond yields minus inflation expectations. So what you're looking at here is when you get real yields falling, right, that tends to boost gold higher. So real yields fall, gold moves higher. Real yields fall, gold moves higher. Real yields fall, gold moves higher. So here we've got real yields falling, gold moving higher. Now the best opportunity comes when you get real yields and the dollar moving together. So you can see here, back in 2016, real yields falling, dollar falling, gold surging higher. Real yields falling, dollar falling, gold surging higher. So if we get real yields falling again, and remember the surge higher in yields has been pressuring gold recently. But if there's a miss in the non-farm payroll tomorrow, we'd expect yields to drop lower and the dollar, and that should cause gold to surge. So at the moment, yes, the dollar's weak. That's helping to support gold a little bit, but yields are still quite high. But if there's a miss, you'd expect yields to drop. So then we get dropping yields, dropping dollar, gold to surge. Now, there's a couple of risks. First risk is that Russian-Ukraine crisis. If that flares up, then it's all going to get worse again. But that will be upside for gold as well. So the latest kind of, controversy over Russia's moves in, is there a peace treaty? No. You see this, if we just take this trend line off, you see here, got that broken trend line. Price closed above, but hasn't managed to break above. So getting above that level technically is important. Near-term risk is just underneath that 1880 region. But I'm only interested in going long gold if we get some miss in the US economic data. And if we get miss in the economic data, then that opens up what's called the stagflationary environment. And if you just take a look at this chart, you'll see here that stagflation, when you get high inflation but slowing growth, is positive for gold. But reflation, high inflation, high growth, is negative for gold. So we're at a real kind of crossroads here. Which one are we going to get? Is the US economy going to be able to keep bouncing? Then gold won't gain. But if they get a stagflationary environment, then gold's going to surge significantly higher. Okay, folks, so that's why the best trading opportunity I can see for this week is like the core PCE data coming in tomorrow and the gold inflationary print. I hope that, I hope that helps and gets you ready for the session. Don't forget that if you want to follow along with some of my midweek posts, do follow me along at Twitter at Giles Coughlin CCA. You can follow me along there at Giles Coughlin CCA. And you can also follow me along at the HYCM blog. I have some, a whole wealth of different articles here. Follow along my trading insights, and I really try to be as helpful as I can for traders. I am a trader, and I analyze for traders. Okay. Yeah. Yeah, Kira, for some strange reason, my question and answer box isn't working today. Could you ask that question again? This has got to be the only time it's ever happened. Oh yeah, what's the difference between Monday and Wednesday webinars? Yeah, Monday webinars, I look at all the economic data points that are coming up, and Wednesday webinar, I tend to look at the best economic trading opportunity, and also over the years, what I do is I outline this point, and I'll just show you. I kind of underline this point over and over again, which is the heart of currency trading is backing strength against weakness. So we're always looking to trade strength against weakness, just like in this article, in this image, Kirash, you'd expect the strong arm to beat the weak arm. When we're trading, we're looking for trades that are strong currencies, trading them against weak currencies. Okay, that's what we're looking at. So a couple of trades that like we've been talking about for a long time and have just closed out is like New Zealand dollar yen and Australian dollar yen upside. So it, let me show you. So here, New Zealand dollar yen, Japanese yen. All right, we've been bullish on this pair for a long time because of the bond yield spread differential between New Zealand dollar and Japanese yen. And if you just like put the New Zealand 10-year bond spread and subtract it from the Japanese 10-year bond yield spread, and that's really important because the New Zealand 10-year and Japanese 10-year yields, the Japanese 10-year yield has been underpinned by the Bank of Japan, right? So there was an obvious yield differential that we expect New Zealand dollar to gain against the yen. Now we've been talking about that from from last year, and just to see that that's come into play now, right? And now that a lot of those moves are exhausted. I'm expecting a retracement now in the yen pairs. That's the main difference. Great. Yeah, well, very welcome. Good to have you here, folks. Good to have you here, Rick. Kingsley, as always, pleasure. Mohammed, Kiresh, for your first time, very welcome. I hope everyone has a very good session. Take care, Safarali, Amir. Thanks, everyone. Now, take care, and don't forget, back on Monday, scheduled to be. Thanks, everyone. Goodbye.